Episode 121, Loan to Cash and Leverage. This is 39.6 Facebook and YouTube Live Finance Show. The show that teaches high earners like yourselves how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, Airbnb, syndications, paying for college, paying for childcare, and even the car you drive. We continue our week of multifamily financials and real estate. Cover some basic topics, loan to cash and leverage. Yesterday, we covered episode 120 and discussed, what did we discuss yesterday? Revenue, NOI, net operating income, and cash on cash returns. Okay, today we're going to go one step further and we're going to talk about leverage, and we call the loan to cash ratio. So I'm going to show a screen. Please let me know if you see this. It should have three scenarios: scenario A, scenario B, and scenario C. If you're watching and you can't see my Excel spreadsheet, please let me know to make sure that this is actually showing up for everybody. Okay, so in the first scenario, scenario A, we're going to purchase the property in cash. This is the same property that we had discussed yesterday, $1.5 million property. And let's just say you have $1.5 million of pure straight cash and you buy it. No loan at all. Okay, so your loan to cost ratio would be 0 because your loan is 0 and the cost is $1.5 million. So 0 over $1.5 million is 0%. We also consider that term the amount of leverage you have. So this is completely unlevered. Now, the down payment effectively is 100%, even though it's not really a down payment, you're just paying for the property. Okay, but so the full $1.5 million is what you need out of pocket. Now, I did not include a line item for capital expenditures and other cash reserves. We're just going to focus on the amount of cash you need to close the deal down. Now, we're going to use the same numbers from yesterday: $120,000 of total income and $55,000 of total expenses. And that gives us a net operating income of $65,000. Now, because there's no mortgage, there's no interest to pay. There's no debt service coverage ratio because there's no debt. So all of your net operating income is the same as your cash flow. So you can define net operating income as your cash flow if there's no mortgage. Okay. The cash on cash return would therefore be that cash flow of $65,000 divided by the original amount of cash invested. So $65,000 divided by $1.5 million, that would give you 4.3%. Now that 4.3% overall, that is your cash on cash return for the property without having a loan. Okay, that number is also effectively actually the cap rate. We're going to discuss cap rates tomorrow. But if you take your cash on cash return without any debt over the value, that's your cash on, that's your cap rate. Okay, so scenario A is for a cash only purchase. Now, when you buy something with leverage, you're borrowing money in order to purchase the asset in an effort to get more return. So if you think about the way a lever works, you have something like on a fulcrum, and you take this beam on a fulcrum, but the fulcrum could be moved over to one side. Okay, so if one half of the beam is twice as long as the other half, so it's not really half anymore, but the other side, you have twice as long of a lever as you do on the other, then you can potentially lift up twice as much weight because you have twice as much distance from the center of the fulcrum to the center of mass of the object. Okay, so by taking debt, you're able to amplify your return on your investment. So in this situation, scenario B, which would be like moderate leverage, you have 65% leverage, which means the loan amount over the cost of the property is 65%. So that would be a down payment of 35% because it's 100% minus 65%. Your down payment here would be $525,000 and the loan amount would be $975,000. So your loan to cost, $975 over $1.5 million, is 65%. Your total invested cash is your down payment here at $525,000. The income and expenses and NOI are all the same. Your debt service here is 3% of your loan value. So 3% of the $975,000 loan, that ends up being about $29,000. Now you're making $65,000 of net operating income, and you divide that by your loan amount of $29,250. You obviously here have a lot more cash flow or net income than you have your debt. You actually have a debt service coverage ratio of 2.2. That's a very big spread. That means in 1 month, you have enough extra money to basically pay more than 2 months of your mortgage service. Okay, now the cash flow is now less than it is in the first situation. It's only $35,750. But that's because you have to pay $29,000 to the mortgage. But what happens when you do this is you get a higher cash on cash return, $35,750 divided by that $525,000 down payment. So now you've boosted up your return to 6.8%. So you've levered your return up. Now, granted, this is at risk because you're taking on more risk when you do this because now you have to make this monthly payment, even if your property isn't earning revenue for whatever reason that might be, or if your revenue goes down, you still have to pay that. So that leverage comes at a risk of having to make these payments, but it boosts your return from 4.3% to 6.8% in terms of cash on cash return. That's a substantial improvement. That's like about 50% more. Now, scenario C is more leverage. You're at 80% leverage. That means you're taking an 80% loan to the cost of the asset. So the $1.5 million property, you're doing 80% loan and 20% down payment. That comes out to being a $300,000 down payment and a $1.2 million loan. This is what we covered yesterday. Now, your total cash outlay here is only $300,000 as opposed to $525,000 in the previous example and $1.5 million in the initial example. So that $300,000 down payment is a lot less, and you're still buying the same exact property. All of the appreciation of the property, you're still going to be able to capture, but you only needed to put in 1/5 as much cash. Now, you have the same net operating income because net operating income is not dependent on your loan payment at all. You then take your loan payment of $36,000 and subtract that from your net operating income, and that gives you a net cash flow of $29,000. Your debt service coverage ratio is $65,000 net operating income divided by $36,000 of debt, which is 1.81. So you still have plenty of space here. Very safe mortgage, $29,000 of cash flow. So it's the least amount of cash flow. But remember, you also put in the least amount of money. You only put in $300,000. And so $29,000 of cash flow divided by $300,000 of invested money is almost 10%. Here's 9.7%. And that's what we got yesterday. So 9.7% cash on cash return, that's a very good return on your investment in terms of the cash on cash. That's like 10%. And you still have the appreciation of the property on top of that. So what does this show? The less money you put down, okay, the more loan you're taking with respect to the cost of the property, and the more leverage you're taking. Leverage is a double-edged sword. It increases your cash on cash return. Okay, so this $300,000 is 1/5 as much as the first situation. You could literally go and buy 5 of these properties with $1.5 million. Okay, so you get a lot more cash flow overall. But you also have to make this mortgage payment every month. So looking at this ratio of how much net operating income you have to the actual debt service is a very important number that says basically how likely you are to be able to continue making that payment. You know, a lot of times they want you to have like 1.25% or so, like 25% more than the mortgage payment in terms of extra money at the end of each month or each year after paying off all of your expenses to help make sure you can make payments. Now, when I talk about real estate and how the returns in general I find to be favorable is because of 2 main things. One is leverage, okay, and 2 is illiquidity. Now, leverage, if you don't do leverage, if you don't take any leverage, you're only getting a 4.3% cash on cash return on this asset, which is still not a horrible return. You're still going to get appreciation likely over time if you're buying the right assets and you hold on to them. And so you can still get good returns, but again, they're going to be a lot lower than they are if you have leverage. And the other thing is the tax issue. When you have a mortgage, you're a lot less likely to pay tax on your investment because you can shelter a lot more of that cash flow or a lot of that income into paying mortgage interest, which is tax deductible. If you don't have a mortgage and you buy something in cash, you're basically paying tax on your entire net operating income, with exception of the depreciation expense. Okay, but if you buy something with 80% leverage, with regular depreciation and mortgage interest payments, you usually are not paying any tax. Okay, if you're paying for something in cash, if you're just doing regular straight line depreciation, you're likely going to be paying some tax on the money. So that decreases that cash on cash return even more because you're not going to keep all that 4.3%. All right. There's another multifamily financial nuts and bolts lecture. Until tomorrow for episode number 122, we are going to discuss cap rates. Until then, this is only for my entertainment, hopefully yours, and not legal, professional, accounting, or any other advice. Please consult with your professional advisors prior to making any of your own decisions with your money. Have a good night.